Today, we're going to talk about artificial intelligence as a market force, not just as a cool technology, but arguably the most important driver of equities and their returns over the last couple of years. AI is real. It's not just a narrative. It's showing up in earnings and in corporate investment budgets. It's actually having a positive gain in the companies that know how to use it properly. The market isn't rewarding every AI story. It's rewarding those with real cash flow and competitive advantage. And your job is to know how to find that. I genuinely believe that this is one of the most important periods in investing history since the dot-com era. And knowing how to separate durable compounders from speculative stories is extremely crucial. I don't see a broad market bubble, but I do see pockets of speculative access in certain themes. Similarly, right now, I believe that kind of story is going to repeat. Companies with strong fundamentals who know how to use artificial intelligence to genuinely increase profitability and their competitive moat are the ones that have a potential of doing well. This time it's not a bubble because earnings per share is actually high. Please remember that crucial difference. AI revolution is real, but it's concentrated in a relatively small group of companies that are actually delivering earnings and free cash flow. The big challenge for individual investors is not, will AI change the world? I think that's almost given. AI is here to change the world. The real challenge here is which businesses will capture that value and at what price, and how do you build a portfolio around them without over concentrating or chasing hype? So welcome everyone. Today we're going to talk about artificial intelligence as a market force, not just as a cool technology, but arguably the most important driver of equities and their returns over the last couple of years. We're going to look under the hood today, which is earnings, margins, valuations, how much of it really is because of AI companies, and where pockets of speculations may be forming. And I'm also going to show you how I process all this information from what we have in Modern Value Investor Framework that I teach in my course. So you're not reacting to headlines, but making decisions based on business quality and fair values. And quick question for you all. Do you personally feel that AI is in a bubble right now? Yes or no? Please type that in comments. I read all of them, and it really helps the algorithm push the video out to more serious investors like you. Now, if you stay till the end, I'm also going to tell you where you can watch a short video that explains my entire framework step by step, so you can book a one-on-one call with me and see how you'd like to apply the same framework yourself. Now, by the way, educational note before I start, anything I discussed today, it's all for educational purposes or entertainment. Nothing in this session is a recommendation to buy or sell any security. So let's rewind a little to see how the year started off. Remember how the market felt in January? There was worry everywhere about Trump's return, inflation, interest rates, tariffs. There was even talks of government shutdown, which has now happened. Now, after Liberation Day, you remember market went down, but soon after that, there was a rally that we saw after the dip took place. Now, I remember very clearly at that time that when the dip occurred, that institutional investors starting shorting the market. Not because there was anything wrong with the market, but they just did not like Trump. So I remember a lot of hedge funds, and I made a statement of that and even brought some figures to illustrate that to you in my past webinars. But in my private community, I said something very specific, that most of this is noise. It's basically policy headlines will come and go, but underneath we've got some serious tailwinds that were helping the stock market move up. And those tailwinds are why S&P 500 is up around almost 16% this year to date. And let me walk you through those tailwinds quickly and show you how they actually worked out as we were expecting. So the first one was the big, beautiful bill that brought together tax cuts, 100% immediate expenses, and deregulation. And that improved corporate cash flows. It lowered cost of capital and encouraged R&D and tech spending, all of which supports higher earnings and, logically, higher valuations. The second was Feds had shifted from aggressive tightening to a more neutral stance when it comes to market expecting further rate cuts into the year 2026. Now, Lower policy rates also reduce discount rates in the future cash flow, which mathematically supports equity valuation. Next is the US dollar and its softening. So when the US dollar is weaker, as it has been over the last little while, multinational companies get an earning boost when they trade or translate those revenues overseas, right? So products that are sold by multinational American companies become cheaper outside. Naturally, people come and buy those products or buy their services. And when that money comes back to the US dollars, well, then at that time, the revenue increases. The fourth is oil prices. So the oil prices have actually moderated. Now, one may think that, recently there has been an up and down that's happening, but if you look at the long-term trend, the oil prices have actually been going down. So energy is a big input cost. So when oil stabilizes, inflation pressures ease and profit margins improve, and the feds get more flexibility. Next was earnings, because at the end of the day, a company's earnings are directly related to the performance of their stock in the long run. In the short term, as we know, the market goes up and down because of emotions. So we know that Q1, Q2, and Q3 earnings all beat expectations mostly. And a big chunk of that strength has come from AI related productivity. Companies that are using AI to increase efficiency rather than just talk about it. And that's why I would say the rally has been earning led and not liquidity led. So when you combine all these things, which are fiscal stimulus, rate optimism, currency tailwinds, lower energy costs, and real earning growth, you should not be surprised that the market is moving up. And this is where disciplined investing comes in. And it becomes very, very crucial, because separating what's temporary policy noise from what's structural AI driven productivity is very important. Okay. And by the way, everything that I'm sharing with you today, how I connect the macro, earnings, and valuations, comes directly from my modern value investor framework. And if you're new here, I put a link below this video where I'm going to walk you through a process in more detail so that you can get to better understand if this training is important for you. Now, here is where I have put key assets on the chart. So what you see in front of you is gold, NASDAQ, S&P 500, Russell 2000, an ETF that tracks Bitcoin, and MSCI World ETF. So let's have a look at how all these have done. S&P 500, as of this morning, was sitting at 15.36%. NASDAQ up until today has returned 20%, and Russell 2000 8.5%. Bitcoin's ETF, which is tracked by an ETF called IBIT, is up 5.46% this year, and the MSCI World Index is up 5.4%. And gold has surged to a whopping 58.03%. And in my last video, I showed you guys why gold has gone up. Remember, gold is a hedge against market uncertainty. So that's why it's gone up. In the next few slides, I'm going to show you the interrelations between gold and how it has been affected by US dollar, and whatever happened in the US dollar, how it goes up and down and affects other things in the market, even the S&P 500. Now, I'm curious, how are you currently positioned? I'd like you to type in the comments whether you're mostly positioned in index. So if that's the case, just type in index. Or if you're investing in individual stocks, and if that's the case, just type in individual. I'd love to see how you guys are doing. And also that gives you an understanding of how other people are doing. Now, here's a slide where I told you that I'm going to discuss the interrelations or correlations between gold and all the things that are happening in the market. So first, what I have here is a chart that shows you the different times when the interest rates have gone down. So we know that there were 3 interest rate reductions that happened in 2024, but this year in 2025, 2 interest rate reductions have already happened. One happened on September 17, and that was from 4 to 4.25%. And then there was another rate cut that happened on October 29, and the interest rate went to 3.75 to 4%. And this is all in the US. Now, while these interest rate cuts happened in September and October, an indication of the rate cuts was announced in August, that there is a likelihood that the interest rates are going to cut. Now, when that happened, notice 2 things happening. At that point, gold started to go up, and even before the announcement, the short-term interest rate started to go down. Isn't that interesting? So that's a correlation. So when the short-term interest rate goes down, guess where the money goes? This money goes into the gold because that's where the investors are looking to hedge their bets. Now, then what happened was in the mid of October, the gold had actually gone up quite parabolically. And essentially at that time, a lot of people came and they started to take profits. So profit taking started happening and gold started to go down. Now, during this time, Fed Chair Jerome Powell came back and said, he basically hinted that the Feds actually may slow down on or pause the interest rate cuts. So they either may slow them down or completely pause them for the rest of the year. When the interest rates stop getting cut, it actually strengthens the US dollar. So when this kind of an indication was given, the short-term treasury yield actually started to go up. And when that started to go up, at the same time, the US dollar also started to go up. So notice right here, US dollar started to increase. Why? Because as people buy the US bond or the US treasury, that strengthens the US dollar. Now, as the US dollar started getting strengthened, guess what? The money that was sitting in gold started moving down to the US dollar. And that also started to bring gold down. So that's their interrelationship. Now, until very recently, while gold was going down, in early November, indications came of the job market, that the job market growth has not been as strong as that they were expecting. So when that kind of news broke out, investors started thinking that even though Powell was saying that maybe the interest rates were going to be cut, they started thinking that maybe the interest rates are going to start getting decreased again. So if the interest rates get decreased, then again, the money starts flowing back in gold, and that's exactly what's happened. So the gold has started to pick up again. So anyways, we're going to see how this actually turns out, but this is right now the intricacies that how things are playing out at this time. Now, moving to fundamentals, remember when I was telling you that one of the tailwinds of the stock market doing well is actually in its earnings reports, right? So every quarter earnings come in. So guess what? The Q3 earnings have mostly come out, and it's been very, very interesting. 82% of the companies have actually released their earnings that have beaten analyst expectations. So that has been absolutely phenomenal. So what does that go to show? That goes to show that the growth of the stock market is actually rooted in fundamentals. And I'll give you some more proofs of that. So this is earnings, right? Now, how have the revenue been doing? So look at this. So S&P 500's revenue, 77% of the companies have actually given higher than expected revenue. So they've also beaten the earnings. So by the way, earnings are net income, just for you know. So this is actually really good. What basically this happening is the market is efficiently rewarding productivity gains. And the growth that is coming from companies that have AI exposure, or I should say exposed to AI leaders. So companies such as Nvidia, Broadcom, Microsoft, Amazon, Alphabet. Market is essentially rewarding productivity gains using AI to automate workflows, improve ad targeting, optimize data center efficiency, or build new AI-driven products. And this is important for our AI bubble discussion that we're having today, because earnings are not flat while the prices skyrocket. Earnings are also moving up, which is very different from how things were panning out in 1999, which was the dot-com bubble. And I'm going to discuss that momentarily. Here's a slide that zooms out all of this and looks at year over year revenue and earnings growth for companies in S&P 500. Now you'll notice that revenues are growing in the mid-single digits while the earnings are growing a lot faster than that. So have a look. So on the left side, I have revenue. On the right side, I have earnings. So earnings is net income. So earnings in the S&P 500 as of September 30th and as of a couple of days ago was growing at almost 8.3% year over year. Whereas a net income is actually growing at faster pace of 13.1%. So remember, net income is equal to revenue minus expenses, right? So if the net income grows faster than the revenue, what does that tell you? That tells you that the margins are actually improving in a very classic cost discipline manner. I think some of this is also coming from AI enabled efficiencies. Why? Because people are being removed, because artificial intelligence is able to do their work. Hence, there is better automation, higher software leverage, and data-driven decision making happening. And the same kind of productivity that we were seeing with certain number of people, now fewer people are required to produce the same. That means the profitability has gone up. Again, from a valuation perspective, this supports the idea that we are in a profitable expansion, not just a story driven bubble. So prices may still overrun fundamentals at time, but fundamentals are also moving in the right direction. Remember, in the long run, if this is a stock market, and let's say this is here is the intrinsic value, there comes a point. So if the intrinsic value, which is the fair market value of a stock, if it's higher than the price of a stock, over time, the stock price is going to come to the valuation point, which means ultimately they should converge. In the short term, fluctuations happen, and that's very normal that's just normal behavior of the stock market. What you're seeing right now is that the profitability of S&P 500 is going up, and we also know that a lot of companies are affected by AI, mostly in a positive way. So if their revenues, net income, profit margins, they're all increasing, guess what? Their valuations are going to increase. And when the valuation increases, do not be surprised. The stock price also goes up. And when the stock price goes up of companies, well, the whole index follows suit with that. And so if we are seeing a growth that's happening right now in the S&P 500 and the stocks for that matter, it's justifiable. There's a reason behind it. Now, here's something very interesting that's also been happening. Despite all the strengths, the US money market funds have also grown in the amount of money that they're holding. Now, this means that instead of money going elsewhere, it's going into short-term bond market. Okay? So from the end of October, which is right here, till the 6th of November, there was a sizable jump in the money market funds. And as of now, which is 6th of November, as of now, $7.53 trillion is currently sitting in the money market funds and is essentially sitting in the sidelines, and it's earning short-term yields, but it's not participating in the stock market growth. Now, there's another layer, which is the policy side. The Feds recently confirmed that they're going to end their quantitative tightening on December 1. And I think this is one of the reasons why so much money has come into the money market funds. This shift from tightening to neutral basically adds liquidity. And let me explain how this works. So on a normal basis, so we have on one side, we have Federal Reserve. So Federal Reserve, and on the other side, we have US Treasury. Normal, when everything is normal, this is what happens. So when everything is normal, this is what happens. Federal Reserve buys from US Treasuries, it buys bonds, and the US Treasury also gives interest. In return, the Federal Reserve gives them money for the US bonds, so dollar for bonds. So they give money to US Treasury, and in return, they get the bonds and they get interest on that. And they keep rotating this. And essentially at this time, the balance sheet of the Federal Reserve stays balanced, which means there's no increase, there's no decrease. And even US Treasury, this balance sheet remains balanced. Or I should say neutral. Okay, so stays neutral. What happened in 2020, so just after COVID, suddenly we know that inflation started to go down and the United States had to come in and start injecting money into the economy. So this is where they infused dollar. And how did they do that? Well, the same thing comes into play here again. So Federal Reserve at this time did something a little different with the US Treasury, but basically to start altering the balance sheet. So what they do is the same thing as always. They buy bonds. So they buy bonds, and in return, they give money to the US Treasury. And the US Treasury gives interest. But in this case, instead of the balance sheets remaining neutral, the Federal Reserve actually takes in more money and starts injecting that. That means they start giving a lot more money to US Treasuries and start buying a lot more bonds. And what this does is, in a time like this, the balance sheet of the Federal Reserve actually expands. And why does it expand? Because they're now suddenly buying a whole lot of bonds. So the asset value of Federal Reserve goes up. But at the same time, the balance sheet of the US Treasury, that also grows because they now have a lot of cash sitting in there. So they take that cash and they start putting that into banks. So the country as a whole starts getting injected with cash. So that happens during quantitative easing time. And this took place this time during the 2020s. But then came the year 2022. In 2022, what happened was inflation started to rise really high. When inflation started to rise really high, then the US government or the US Federal Reserve wanted to take the cash out of the US economy, which is they wanted to tighten the liquidity. And how did they tighten liquidity? Well, they kept doing the same thing, but instead of injecting money, they actually stopped buying new bonds. So here's Federal Reserve. So what they did was they would take the bonds plus interest, but they would not give any more money. They say, whatever you have sitting there, we'll take that bond back. When it matures, we're going to just keep the bond, the principal of the bond after it matures, and we're going to keep all the interest. But we're not going to put new money. What this does is it sucks out cash from the US Treasury. And at this specific time, the balance sheet of the Federal Reserve starts to shrink because there are no more buying additional assets. Cash obviously increases, but the assets go down, so the balance sheet shrinks, and the money supply in the economy also starts to go down. Now, what's happening, what's coming up in 2 weeks on December 1 is that Federal Reserve has said that we're now going to stop the quantitative tightening. So this quantitative tightening is going to stop. What that's going to do is they're going to go back to the neutral zone. And in that case, if this is Federal Reserve, this is the US Treasury, they're going to keep buying bonds and they're going to keep buying bonds and keep giving money to the US Treasury, but they are not going to inject new money. So no new money. What's going to happen is at this time, the balance sheet of the Federal Reserve is going to now start becoming neutral, and they're coming to a more neutral and natural zone. And why are they doing that? Because they have recognized that at this time, tightening is not required and the economy doesn't need extra cash. This is a good time to just start coming back to neutral. Now, this is a good thing. When something like this happens, this kind of an indication goes to show to investors that economy is coming back to a normal zone. And I think that's going to be another tailwind for the economy. Now, folks, like I mentioned, everything that I'm showing you today, connecting macro tailwinds, earning data, sector leadership, and liquidity, is the same process I use in the Modern Value Investor program in my training. And most of my students are engineers, scientists, and people from analytical professionals. They're not looking for stock tips. They want a repeatable framework that they can use to filter out low-quality companies, estimate fair market value, and build a profitable portfolio that they can manage without relying on anybody's Telegram channel or somebody giving stock tips. This framework is designed to eliminate over 99% of the listed companies from consideration and focus your time only on a small minority of companies that have durable competitive advantages, strong balance sheet, and attractive long-term economics. If you want to understand that framework in more detail, I've recorded a short 10-minute video that you can find by clicking on the link below this video or scan this barcode. Again, watch this video after we are done here. And if this approach resonates with you, you can book a short Zoom call with me and I will personally be there to see whether joining this next cohort will make sense to you. Here's a table that sums up AI phenomenon since the late 2022. You know what? Price returns for AI-related stocks so far have accounted for over 180% return in the S&P 500. Earnings growth of these kinds of companies has been 124%, and the CapEx and R&D growth has been over 60%. And these are same companies that account for roughly 3/4 of the S&P 500's total gains in that period. So two key points I want you guys to remember. AI is real. It's not just a narrative. It's showing up in earnings and in corporate investment budgets. It's actually having a positive gain in the companies that know how to use it properly. However, the second thing is that this is narrow. Only a small subset of companies are driving most of the gains. If you owned the wrong 90% of the companies, you'd probably underperform the index even in this strong environment. And that's exactly why I focus so much on business quality and economic moat inside the course. The market isn't rewarding every AI story, it's rewarding those with real cash flow and competitive advantage. And your job is to know how to find that. So, the natural big question is, which is also why we're here, are we in an AI bubble? So let's look at this from a data point of view rather than emotions. So the S&P 500's forward PE ratio right now is sitting at 22 to 23 times its earnings. So this is the regular PE of the S&P 500. Now this is higher than the typical 10-year average, but it's nowhere near the dot-com extremes that we saw in the year 2000. The AI leaders right now are trading at around 27x their earnings, right? But their PEG ratio, which is PE divided by the growth, is only 1.3. And this is lower than the 1.6 to 1.8 PEG ratio that used to happen during the dot-com bubble. Also, right now, the market leaders that are in AI, their profit margins are anywhere between 25 to 35%. And you know what they were during the dot-com bubble? Very low, often negative. So right now it's very different. Now, free cash flow margin right now for the leaders is greater than 80%, whereas previously it was less than 30% of the index. And balance sheet cash. So currently, a lot of companies like Nvidia and even Google that are heavily using AI right now, well, they have hundreds of billions of dollars in free cash flow in their financial statements. That was not the case back in the dot-com bubble. So the way I would put this together is that this looks more like strong, profitable expansion than classic speculative mania that we saw in the past. Prices can certainly overshoot fair value. That's very normal. But this isn't like 1999 where many companies had no earnings at all. Okay, so here's how I would frame it. The risk today is less that everything's going to zero. So that's not really the risk. I think the bigger risk is that people who buy the wrong names at the wrong prices may face heavy drawdowns even while AI trend continues in the positive side. That's why I always say, folks, education before execution. I genuinely believe that this is one of the most important periods in investing history since the dot-com era. And knowing how to separate durable compounders from speculative stories is extremely crucial. Do you feel that we are in an AI bubble, or do you not feel we're not in that? So if you think we're in an AI bubble, please type in bubble. And if you don't think we're in a bubble, type no bubble in the comments. And I'd love to see what the audience thinks right now. And my answer would be yes, there is a bubble, but it's in a selective case. I don't see a broad market bubble, but I do see pockets of speculative access in certain themes. So for example, some early stage unprofitable AI infrastructure names, yeah, there's a bubble there. There's a bubble around quantum computing stocks with minimal commercial revenue. There's also a bubble in crypto-linked equities that move based on digital asset sentiments rather than on business fundamentals. And certain advanced nuclear and uranium-related plays where valuations have run far ahead of project executions. Now, many of these names that I share essentially have four features. Number one, limited or negative earnings today, because remember, ultimately fundamentals are very important and fundamentals can be found by analyzing the financial statements. Limited or negative earnings today, heavy reliance on long dated or speculative technological or regulatory success. So they think there is going to be success in the future, so they're chasing that. So it's speculative. Then also frequent capital raising and potential shareholder dilution. So when they raise cash by issuing shares, more shares come outstanding in the market, value all shareholders. So these are the reasons why I think what is common among the companies where there are bubbles that currently exist. The educational point here is that this is what speculative valuation risk looks like. And as investors, we don't have to avoid innovation, but we should size these exposures carefully and understand that they belong in speculative bucket in a portfolio, not the core. And you got to know how to treat speculative investments in your portfolio. What kind of exposure, what kind of risk you want to have. And again, I want to caution this with an educational disclosure that nothing here that I'm mentioning is a buy or sell recommendation for any security. These examples are purely for illustration so that you can understand how valuations and risk differ across segments and across markets. When I think about the dot-com bubble that happened, I was an undergrad, I was studying engineering at that time, and I remember anything with a dot-com was attracting investment. Left, right, and center, people were putting money. And people were wanting to associate with names like these that had dot coms. And I'm noticing a very similar thing right now. Anything with an AI is just getting investments. But if you go back and make a parallel with what happened in the dot com, companies that had strong fundamentals were the ones who were able to use the dot com and hence the internet technology to their advantage. Similarly, right now, I believe that kind of story is going to repeat. Companies with strong fundamentals who know how to use artificial intelligence to genuinely increase profitability and their competitive moat are the ones that have a potential of doing well. But I think a lot of other artificial intelligence companies may just wither away because if you don't have the right fundamentals and the right moat, which is a barrier to entry from competitors, they may just wither away. Now, to put valuations in context, here is a forward PE of S&P 500 over several decades. And I just mentioned that right now the S&P 500's PE is 23x, which is obviously very high. But is it really high? And I want to talk about the history. And this is also one of the reasons why I created my program and I call it the modern value investor, because the metrics that worked in 1970s, 60s, 80s don't necessarily work right now. Let me prove it to you. This forward PE chart is from 1985 all the way till like yesterday. So notice from 1985 to 1990, check out what the PEs were. So PE at that time, it was very normal for a PE to be between 10 and 14. So this was the average. Interest rates at this time and inflation were very high, which meant that there was a higher discount rate. So if you could earn 8% in a government bond, then paying 20x in earnings for a stock made very little sense. The economy was more industrial, low margin, so the lower multiples were reasonable, right? At that time, you had companies that you can touch and feel. You had AT&T, for example, that had physical switches for telecommunication. You had factories, you had industries that had physical machineries. Then in 1990s to 2000, notice what happened from this period. The PE gradually started to go up. Now, this was also the dot-com optimism, which ended up pushing the valuations all the way to like 25x. At this time, while the price was rising compared to the earnings, which is the net income, many companies had little to no earnings or little to no net income. So if in PE, which is price over earnings per share, if the price is increasing and earnings per share is flat or negative, well, guess what? For the PE to increase, this price has to be super, super high compared to its earnings. And that's exactly what was happening at that time. Hence, I would say that was a bubble. This time it's not a bubble because earnings per share is actually high. Please remember that crucial difference. After that, the market corrected itself and came back to reality. From 2003-ish to 2015, somewhere around this time frame, which was after the bust of the financial crisis, we had a long period of consolidation with PE, and it mostly hovered around 13 and 17. So it was mostly around like this area, right? Growth was slower, but rates kept drifting downwards as central banks continued to cut very aggressively. In 2016 to 2025, so right here, this time frame, the structure of the index changed. Roughly 40% of the S&P 500 at that time ended up becoming tech and healthcare heavy. And what's common in these companies? Well, these companies are asset light. They have high margins and they have recurring revenue businesses. So with ultra low rates, more efficient business models, the normal range of PE moved to around 20 to 23%. So this around this time became the norm. That's where the PE started to float. So when we look at today's market, which is around 22, 23, right? It is very elevated, but it's not automatic to think that this is crazy. When you consider lower structural interest rates, and high average quality and profitability of index constituents. That's why in the modern value investor framework, we don't blindly use the old Graham era rules like anything below 15x PE is expensive. We look at the context, we look at the growth, margins, balance sheet, and business model. Practically, this chart gives you an anchor. So when you see a company that is 35 times its earnings, you can compare it to the average of the market PE, which is around 23 at this time. And then you ask yourself, is the market pricing that specific stock in a way that it has a higher growth? Does it have a higher quality? And do the fundamentals actually justify the premium? And that's how you should be thinking. Now, the PE is the PEG ratio, which is price to earnings divided by growth. So PEG ratio is a way that you can compare or do an apples to apples comparison. So if a price to earning of a company is too high, but the growth is very high too, the PEG ratio is going to start normalizing. But if the price to earning is high and the growth is low, then the PEG ratio is going to increase. So PEG ratio is a way to start to compare the price to earnings with the growth. And a PEG ratio of 1 means the PE roughly matches the expected earnings growth. And historically, during the late stages of a bubble, the PEG ratio was typically high. So let's look at this. In year 2000, just before the dot-com bubble, at that time, based on its normality, the PEG ratio was at its highest. So then obviously it corrected. Look what happened in 2020, just before the COVID crash. The PEG ratio had reached 2.4, which is quite high. But right now, if you look at, the PEG ratio is sitting at about 1.35, 1.36. And that happens to be more in line with how things have been on an average. So still, I would say it's slightly on the higher side because 1 would be the perfect, that the price to earnings and the growth are essentially equal. But right now, the price is a little higher than the growth rate. But it also means that the risk level is not that much. This means the data is supporting a very nuanced view, which is the broad market appears to be priced slightly rich. We also know that select AI leaders appear to have high but not absurd valuations, and the real pockets of bubble risk are more in speculative corners that I just discussed. That is why when I use multiple valuation lens inside my process as well, which is PE, PEG, free cash flow yields, and more, rather than just relying on a single metric. In fact, we use multiples to triangulate fair value and build conviction inside our portfolio when we're valuing a company instead of just relying on one method to find the intrinsic value. And I always say, because we don't know the future, so when you use multiple ways, such as PEG, free cash flow yields, a whole bunch of other things that I teach in my course, and then you use DCF, then you can say that, the number that we're getting, does it actually make sense? Or do we need to adjust that? Which you're not going to get from just one method of calculating the free market value. Now, before we wrap up, I want to zoom out to real economy, which is inflation and growth. On the left side, you're going to see inflation. So inflation had obviously peaked in 2022, but ever since then, the inflation has been going down. Now, certainly it hasn't gone down to the 2%. So it hasn't gone there. It's actually interestingly slowly started to creep up, which is probably why Feds recently came out and they said, maybe we're not going to cut the interest rates. But if the job data keeps coming out not as nice, then the Feds may have no choice but to cut interest rates. But that goes to show that the economy overall, the inflation has gone down, which is a good sign. And the other is when you look at the GDP. So these are GDP results that have already come in for Q2, and it's sitting at 3.8%. Now, it certainly isn't at the level where we were in Q3 of 2023, but it still is high. And if you look at post-COVID, the GDP growth rate was much higher. But still, this shows that the GDP has been growing, and that is a good sign. Now, let me summarize all that I've told you today and where to go next if you want to go deeper. AI revolution is real, but it's concentrated in a relatively small group of companies that are actually delivering earnings and free cash flow. Second, valuations are elevated, but they're not at absurd levels at the index level. The real bubble-like behavior is in specific speculative pockets, some early stage AI, quantum computing, crypto-linked companies, or companies that are in nuclear and uranium plays that are just overly hyped. Liquidity conditions are improving. The Fed is ending quantitative tightening. Rate cut expectations are in place. And there is still around $7.3 trillion of cash sitting in money market funds. This can all get shifted into the stock market, which can be a fuel for the stock market. From a macro standpoint, inflation is moderating, obviously not at 2% level, but still it has come down. And the growth is positive, which is the GDP growth, which historically supports high quality equities. The big challenge for individual investors is not, will AI change the world? I think that's almost given. AI is here to change the world. The real challenge here is which businesses will capture that value and at what price, and how do you build a portfolio around them without over concentrating or chasing hype. That's exactly what I teach in my program, Modern Value Investor. I have a framework in there which will teach you how to filter out over 99% of the companies and companies that don't meet your strict investment criteria. It'll teach you how to estimate the fair value of companies and develop conviction using fundamentals and triangulation. And it'll help you design a diversified rules-based portfolio that you can manage with confidence through different market cycles. If this approach resonates with you, here's what I want you to do next. Watch a short video that's linked below this webinar. You can scan the QR code if you want. And in it, I'm going to walk you through a full 8-step framework in more detail and show you real examples of how I apply it. If after watching that, you feel that this is a type of structure that you've been missing, you'll see a link on that page to book a short Zoom call with me personally. On that call, I will be available and we're going to look at where you are in your investment journey, what's holding you back, and whether joining the next cohort of the Modern Value Investor Framework makes sense to you. Folks, thank you so much for spending your time with me. Final prompt I want to ask you is that if you'd like to see more sessions like this, let me know in the comments which topics you'd want to see. For example, do you want to see a deep dive in a certain kind of a sector? Or do you want me to talk about something that the feds have said? I look forward to seeing those responses inside, and I also look forward to seeing you again in the next webinar. Thank you, everybody.